Hello everybody, this is Lara at Pure Elliott Wave with your end of the week analysis for the S&P 500 for the trading week ending Friday 17th of September 2021. There is still shallow bearish divergence between price and the AD line. It's just over 2 months now for the NYSE All Issues AD line. There's a little bit of short-term bullish divergence starting to develop though between price and both of the AD line and inverted VIX. It suggests that this pullback may be just another pullback within the ongoing bull market and it may end early next week. The target for support is 4399. My main Elliott Wave count expects now that this is the last pullback within the bull run before we see a bear market arrive in the form of primary 2. I have an alternate which allows for one more pullback along the way up before the bear market arrives, and the second alternate, least likely, allows for the possibility a bear market has already just begun, but we need some confirmation of that before we can have confidence. So I have 3 Elliott Wave counts and I will rank them in order of probability. This is the most likely at this stage with the data we have in hand. A bull run began here in March 2020 and I am labelling it Cycle Wave 5 and I expect it could end in 2029, although it'll be interspersed by a short bear market for primary 2 and possibly primary 4 could also meet the definition of a bear market. We're not there yet though. Cycle Wave 5 looks like it's subdividing as an impulse, which is the most likely structure for it to be. It will be labelled primary 1, 2, 3, 4, 5, and primary 1 looks incomplete. Primary 1 looks like it's subdividing as an impulse, with intermediate 1, 2, and 3 complete, and intermediate 4 may end next week. Intermediate 3 here is close to equality in length with intermediate 1, but it's actually a little bit shorter. That's important because it tells us that 2 things. Intermediate 5 may not be longer than equality in length with intermediate 3. I give you that length in the text article. It also suggests that intermediate 5 may actually be quite a lot shorter, or could be surprisingly short and brief. It may be over in just a very few weeks. Intermediate 4 may end next week. It can't move into wave 1 price territory below 3588.11, but it shouldn't get anywhere near that point. If it moves below the end of minor 4, which is unlikely, if it does that, then I'd look for support at the lower edge of this channel. If this channel is breached, we have a very bearish wave count, which would then be the main wave count. We are not there yet. Let's take a look at the daily chart, where this high for minute 3, we're looking at minor 3 with an intermediate 3. The end of minute 3, the strongest portion of upward movement, is this point up here. Here's the end of minor 3 and minor 4, an expanded flat, and minor 5. Now we're looking at the structure of intermediate 4. It may be subdividing as a zigzag, A, B, C. This would see it have no alternation with the structure of intermediate 2, but it would have alternation in depth. Alternation is a guideline, not a rule, and by an extremely wide margin, zigzags are the most common Elliott wave structure. We don't always see alternation in structure. We should expect it, but in this case I'm going to have my main wave count seeing a zigzag for intermediate 4 due to the look of proportion, to give the right look to the wave count at the daily and weekly chart level. I will allow for the possibility though that we may need to move the degree of labelling within intermediate 4 down 1 degree. This could just be minor A to end at 4399. We'd then expect a big bounce for B and then C of a flat, or we could just see sideways movement in a triangle for a few weeks yet. That is also possible. Depending on the strength of upward movement next, I may discard the idea or I may start to chart it at the daily chart level for you. For now, let's just look for the end of the zigzag for intermediate 4, most likely to end next week, maybe Tuesday, about 4399, possibly Wednesday, depending on how slow minor wave C unfolds as. At the weekly chart level, this is now an alternate wave count. Last week it was the main wave count, but I would have expected if this pullback is minor 4 that it would have ended this week, but this short-term structure at lower time frames looks like it needs a little bit more downward movement to go. If we just see upward movement next week though, and we don't see downward movement to my target at 4399, then this may actually be a reasonable wave count with a high probability. The probability between the first weekly chart and this weekly chart actually isn't that much of a difference. And it makes a difference going forward, because if we expect this pullback is only minor wave 4, then we should be looking out for one more short-term pullback along the way up to complete primary 1, whereas the main wave count expects a short intermediate 5 to complete primary 1 quite soon, and then a big bear market for primary 2. This wave count expects a slower end to primary wave 1 that could take months yet to complete. Within primary wave 1, minor wave 3 and 4 with an intermediate 4 may be unfolding. Minor 4 may not move into wave 1 price territory below 3549.85. Here it is at the daily chart level. Here's the end of minor 3 and minor 4. The structure is the same as I'm seeing it for intermediate 4. The target is the same. The channel's a little different, but the whole structure and expectation is the same. For this one though, I wouldn't look at moving the degree of labelling down within minor 4. If this is minor 4, it should be over early next week, possibly about the target. At the weekly chart level, this is a very bearish wave count. We absolutely need to see a breach of this channel before we can have confidence in it. This is presented as a what if, because in February 2020 I didn't have a bearish wave count and a surprise bear market developed. Conditions now are a little bit different. There is actually just over 2 months of bearish divergence between the NYSE All Issues AD line and for Lowry's operating company's only AD line. There's just over 3 months of bearish divergence. The bear market that began in 2007 was preceded by only 3 months of bearish divergence between price and the AD line, although in that instance it was pretty clear and strong. At this time it's very shallow, so it's not nearly as strong. But conditions do exist now for this possible wave count to possibly be correct. So let's consider possibilities, even though they may have a low probability. Low probability doesn't mean no probability. I know I keep saying that, but I do have to keep saying it because I think sometimes people don't quite understand that this is an exercise in probability. If this channel is breached by a full daily candlestick below and not touching it, then this may be the main wave count, and then we would expect a bear market to continue. I'd label it primary 2. The target for support would be the 0.618 Fibonacci ratio of primary 1 at 3091.08, and primary 2 may not move beyond the start of 1 below 2191.86. This invalidation point is absolute, not even a fraction of a point on a tick chart. Would invalidate this wave count, so it wouldn't be expected to happen if this is the correct wave count. If that happens, I'd have to move the degree of labelling here up 2 degrees and expect that grand supercycle 1 could have been over here. The probability of that is exceptionally low, extremely low. I'm not prepared to chart that. Technically possible, as in so many things are possible. Okay, at the weekly chart level, last week we saw a bearish engulfing candlestick pattern, but I did warn that there were previous examples on this chart that were not followed by any downward movement. They were followed here immediately by upward movement, here again immediately by upward movement, but this week it's got some downward movement to follow it, so we can consider that a bit of confirmation of the bearishness of this candlestick pattern. So let's expect at least a little bit more downward movement. An increase in volume this week because Friday was close to the options expiry day, but for Friday, down volume did dominate total up-down volume, and volume is increasing, so it's downward volume which is supporting or pushing price lower, and that is bearish. On balance, volume is constrained. It's getting pretty close to support here, but this isn't particularly technically significant because there's only 2 anchor points. RSI is in neutral territory. There was bearish divergence previously, but it's just disappeared. There is no bearish divergence between price and RSI at this high, and so that would tell us to most likely expect this to be another shallow short-term pullback within this ongoing bull market. We've seen pullbacks before. These are not bear markets, these are pullbacks within an ongoing bull market, and I expect that this one is likely the same, and it's unlikely to make a new short-term swing low below this price point. There is still a series of higher highs and higher lows, the basic definition of an upward trend. ADX is declining at this weekly chart level because of all those little pullbacks. It just can't catch up with the trend, and MACD is bearish, and ATR declines as price moves higher. Absolutely normal behavior for this market. Here's our options expiry volume. Down volume did dominate total up-down volume, and so this is still bearish, but not necessarily as bearish as this big spike suggests, but it is bearish. Volume is pushing price lower. There is support here about 4425. If price can break below that, look out for next support about 4370, and if the bull market remains intact, we shouldn't be seeing a new swing low below this point. If we do see a new swing low below that point, then the analysis is going to have to shift to more bearish, because at this point in time there is still a series of higher highs and higher lows, the definition of an upward trend. The 55-day moving average has been providing support. Price is pretty much there. We may expect this should be another pullback within an ongoing bull market until proven otherwise. ADX at the weekly chart level, however, gives us a strong bearish signal indicating a new downward trend. It did that before back here though, and it didn't really develop into anything back here. ATR is increasing as price falls, normal behavior for this market. There's a weak bearish signal from on-balance volume at the end of the week. RSI is in neutral territory. There's plenty of room for price to rise or fall. At the daily chart level, there was bearish divergence still evident between price and RSI. It was over a reasonable period of time too, but it was very weak. And so following very weak bearish divergence, I wouldn't necessarily be expecting a big deep pullback, and certainly not a bear market after this. For a bear market to arrive, I'd be expecting some stronger and clearer divergence between price and RSI. It doesn't always happen, it just happens more often than not prior to a bear market. A balance of probability we're dealing with here. MACD is bearish but not fully so, and stochastics back in neutral territory. What about breadth and volatility? Breadth still has this cluster of bearish divergence, but it's pretty shallow. Here's the all-time high for the AD line, and here's the all-time high for price. Price was making new highs, but breadth was failing to make corresponding highs. Upward movement for price was not supported by rising underlying market breadth, which is bearish, but it's only just over 2 months worth, and it's pretty shallow. A couple of downward weeks may have been enough to resolve that. We could see it develop further. I would actually expect to see this develop further as primary one finally comes to an end. At the daily chart level, I put this red line very carefully along the all-time high for the AD line, the NYSE issues, or all issues AD line this is, and here's the corresponding point for price. Here's price's all-time high, and it's not supported by rising market breadth. We didn't see a new all-time high from breadth here. Divergence is very shallow, but it does still exist. But now we've got a couple of bullish signals from the AD line. This one's really, really weak, but this one from Friday is a little bit more interesting, gives us a little bit more indication that this is likely another short-term pullback within the ongoing bull market. Friday's made a new short-term low below this prior point, but the AD line hasn't. Downward movement doesn't have push from a corresponding decline in market breadth. Breadth remains slightly more healthy than price at this point. This is bullish for the very short term. It suggests the pullback may be over sooner rather than later, and especially because we also see very short-term bullish divergence between price and inverted VIX. This week, inverted VIX has moved slightly higher, price has moved a little lower. This is short-term divergence. We also have this short-term bullish divergence existing from last week between VIX and VVIX. VIX has made a new short-term swing high, but VVIX hasn't made a corresponding short-term swing high. The volatility of VIX is lower than VIX. This is bullish for price for the very short term. At the daily chart level, like at the AD line, inverted VIX has moved lower, as has price, but price made a short-term swing low. Inverted VIX failed to make a corresponding short-term swing low. This is bullish for price for the short term. Downward movement in price for Friday does not come with a normal corresponding increase in market volatility. Volatility remains a little subdued, which is bullish for price for the short term. And likewise between VIX and VVIX. VIX has made a short-term swing high, but volatility of VIX is lower. The volatility of VIX is subdued, which is bullish for price for the short term. That's all for me with your S&P analysis. I hope all our members are looking forward to a fabulous weekend.